Hello and welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The atmospherics were good. I think that, as we all know, a big country trading with the U.S. could take months and months and months to get a deal done. They may have to extend deadlines. The bottom line here is this is a positive development.
I flew back at 4 a.m. this morning to be here this morning, and we are...
It's a simple yes or no question.
No, it is not a simple yes or no question. We are in the midst of constructing it, and back to your question, China has proven an unreliable partner in strategic...
Will you commit to consulting with us on trade deal with China?
Gentlewoman's time has expired.
The big surprise was the large decline in energy at 1% and a really large decline of 2.6% in overall prices in gasoline.
I think it can very well be an accurate picture of where we are as of last month. It's not necessarily really telling us where we're headed by the end of this year. And that's a big question as to exactly how these tariff costs, which we know they're being collected, we see them in the Treasury statements, where are they going to go?
1 hour to go until the market close. We're taking a look at the major averages that are stalling out a little bit here. There's a lot for investors to weigh right now, right? There's this sort of tentative provisional trade framework for a trade deal between the U.S. and China. There was the CPI numbers that came in this morning a little bit better than estimated. And stocks had been holding up pretty well. Not great, not seeing huge gains. Now we're seeing declines, though. 46 points for the Dow, about a tenth of 1%. The S&P now down 0.4%. The NASDAQ down 0.6%. But all of them have been sort of bouncing around throughout the course of the day.
Yeah, a couple of big themes. I think you hit on them, Julie. One is President Trump going on social media this morning and talking about, as you said, got this new effort, this new framework to get back to negotiations. Plenty of questions there. Our colleague Ben Werschkul pointing out, at least it looks like we're not moving in the wrong direction, but a lot of questions still for investors. Yes. We got Ben coming up who's going to walk us through that. The May CPI report was also pretty interesting. I saw one economist put it like this, told his clients it was shockingly benign. That's what he said. Shockingly benign. Appeared to be no impact from tariff hikes. But for investors, of course, you're looking forward and saying, is this the calm before the storm?
Right.
Could price hikes be coming? And we've got an economist on the show to walk us through it.
And at one point after that report, I think that there was a 75% chance being priced in of the Fed to cut interest rates, not at next week's meeting, but perhaps at the meeting after that. I want to point out what we're seeing in the 10-year yield, given the CPI numbers, 4.42%, a drop. What's notable here is how different it looks from those stock charts. In other words, this reacted to CPI, and then it stayed there. We did not see that kind of fluctuation over the course of the day, the volatility like we're seeing in the stock market, which is kind of interesting there. And then in terms of what's on the move here, oil prices up big today. Energy, the only group, though, that is in the green right now. It's been rising over the past couple of days. Materials and consumer discretionary taking a hit. As always, we check on big tech to see how it is doing today. Here, a very mixed picture with the exception of Broadcom up 3.1%. That's really the kind of standout to the upside here today. Otherwise, seeing a lot of red.
And Oracle after the close, at which
That's
point
right.
you get another check on that cloud environment.
Yeah, I can't find Oracle on the screen right now. You help me out if you see it. It's in there somewhere.
We're up about 7% this year. Nice, about 40% over the past 12 months for Larry Ellison.
Buying it. As mentioned, it has been a busy day on Wall Street with investors digesting not only a new China-U.S. plan, but also a federal appeals court ruling that President Trump's tariffs could stay in force for now, and Treasury Secretary Besson testifying before the House Ways and Means Committee today, and soon the Senate. For more on all of this, we've got live team coverage. Let's welcome in Yahoo Finance's Ben Werschkul, Alexis Keenan, and Jennifer Schonberger, all of them joining us right now. Ben, let's start with you. Set the scene for us here as we turn to this, the negotiations that we've been seeing.
Sure thing, Julie. Yeah. So what the White House has agreed to is what they're calling a framework to implement the Geneva Consensus with China. What exactly that means is still being worked out. Trump immediately touted it as a done deal, but Treasury Secretary Scott Bessent told Congress today that they're still in the process of constructing it. Either way, the goal of these talks was essentially to take a few issues off the table so that negotiators in the months ahead could get to bigger issues such as tariffs. The two big issues are export controls and rare earth minerals, basically to reverse some recent backsliding there so they can get back to the tariff issues. The evidence so far here we have is that what they agreed to is a very kind of limited agreement. On the rare earth front, what the Wall Street Journal is reporting today is that China is going to give on this. This was the number one issue for the U.S. side, but at least in the case of U.S. manufacturers, only for 6 months. So sort of permanently off the table, this is very much not. Likewise, on the export control side, there's going to be some give from the U.S., but we don't have clarity yet whether that includes semiconductor design and manufacture. That's been a giant issue for the Chinese and has real national security implications for the U.S. side. As you mentioned at the top, the overall reaction here is that these talks underline that a comprehensive deal is a long ways off, and the details of this one are pretty uncertain. But at least it couldn't have been worse. You know, as one analyst said, at least relations aren't going to worsen over the next few months as talks continue.
And now turning to the legal battle involving President Trump's tariffs, let's get to Alexis with the latest on that. So a temporary reprieve.
Another reprieve, and this comes from a federal appeals court for the Federal Circuit in Washington, D.C. They said the Trump tariffs, these Liberation Day tariffs, that they can remain in place while the court considers the broader issue, right? And that is whether President Trump had authority under that Emergency Act to enact these tariffs by executive order. The court issued an expedited schedule. They want the parties, the challengers, and both the Trump administration to put their arguments out there, be prepared to go to oral argument on July 31st. The court said that this issue is of exceptional importance. Now, at a minimum, though, this stay, this reprieve, it buys the administration some additional negotiating time, right? Because if the administration is to reach some agreements country by country, to an extent, this becomes a moot issue, right? Maybe not for an appeals court, maybe not for a potential Supreme Court argument as to any of president's authority under the act that president used, the IEEPA. But if a deal is reached, then there's some headway there for the administration. So meanwhile, you can expect that this appeals court will go forward. Sometime after July 31st, we'll get a decision from the court. And then the Trump administration has promised that if it doesn't get what it wants, it will go to the Supreme Court. In asking for this stay, the Trump administration told the appeals court this. They said the trade court's injunction, that's the lower court here that invalidated the tariffs, that they unilaterally diminished America's bargaining position, the administration said, during a sensitive trade negotiation time and encouraged other nations to hold our nation hostage. So for now, on pause, and that timeline there, we can expect something after July 31st.
What are your thoughts, Alexis, on whether the Supreme Court would address this issue while it's on summer recess?
Yeah, you know, this is an issue that has not been taken up by the Supreme Court. They have not considered this particular emergency act and whether the president has this extent of authority. So they very well might. We just don't know. But what it does, though, is the timing of this, it would put an appeal to the Supreme Court right in the center of the beginning, right in the beginning, really, of its summer recess. So that would mean that the court would have to decide on yet another stay, which the parties would ask for, which the administration would ask for. That would bring them back in to issue some kind of emergency decision where we might not learn what their thoughts are on these broader issues.
All right. Well, all of this, and we're also watching U.S. Treasury Secretary Scott Bessent on Capitol Hill today, testifying before lawmakers. Our Jennifer Schomburger has more on that. Hi, Jen.
Hey, Julie. In a hearing before the House Ways and Means Committee verging on nearly 5 hours, Treasury Secretary Scott Bessent defended the administration's tax and trade policies, saying that the deal struck with China last night was for a specific goal, but the overall negotiations are going to be a longer process. He said that China is an unreliable partner and warned Beijing to hold up their side of the bargain. When asked what we should expect at the end of that 90-day pause, which will be up on July 9th, He said that trading partners that have been negotiating in good faith could see that deadline rolled forward to allow for more time for talks, whereas those who have not will not. Meanwhile, the secretary defended the tax bill, saying failure to pass that big, beautiful bill would result in the biggest tax hike in history and job losses, while Democrats pushed Besant, warning that the bill could lead to an increase in the deficit. House Ways and Means Ranking Member Richard Neal says the administration has its head stuck in the sand, while Representative Boyle rattled off Elon Musk's criticisms of the bill, in which he had called it an abomination. Listen.
Why do you believe Mr. Musk is right or wrong?
You'd have to ask Mr. Musk.
I will take the substance of what he said. Does it not add trillions of dollars, your bill, to the deficit and debt?
It's not my belief that it does. It may be his. He can speak for himself.
Meanwhile, asked by Representative Kustoff whether he would rather be Fed chair or remain Treasury Secretary, he had this to say.
I have, with the other than some congressional reporting, the best job in Washington, and I would like to stay in my seat through 2029.
Besant also defended an arcane section of the House tax bill known as Section 899, which would tax foreign holders of U.S. assets by 5% every year, all the way up to 20%, saying that if a European company tried to unfairly tax a U.S. company, that would actually fall back on the multinational European company. He said this is a fiscal bill, not a revenge bill. And after all of that testimony today, Secretary Besant still has more. He will head over to the Senate side of the Capitol, where he will testify at 4 o'clock.
A long day for Mr. Besant. Jen, Alexis, Ben, thank you all guys for the team coverage. Even as tariff uncertainty lingers, consumer prices increase less than expected for the month of May. The cooler inflation data boosting hopes for a Fed rate cut. HSBC US economist Ryan Wang joins us now to discuss. Ryan, it's great to have you on the show. So regarding that May CPI print, Ryan, I saw an economist telling his clients today it was shockingly benign. That's how he put it, Ryan. You agree with that?
Well, I agree that it was lower than expected. And it's basically been 2 months in a row that we haven't really seen very significant inflation pressure come through in the monthly CPI report the way that one might have expected from higher tariffs. And I think what it shows us is that it's not going to be a simple outlook going forward. There is actually, I would say, double-sided risks to prices coming from tariffs. It's probably still true that goods prices in particular will probably rise over the remainder of this year. But at the same time, if labor market conditions are starting to cool down, and I think recently we have had some evidence that that's the case, that's actually something that's going to put some downward pressure on inflation. So I think it's very much a mix. And there's no doubt that today's report was relatively benign from an inflation standpoint.
Ryan, we were just showing some of the price changes, particularly the upward price changes over the past month here. Things like appliances did see something of an increase, randomly peanut butter, so it's always kind of a mixed bag of what's going up. I guess I would ask, for what is going up, why is it going up? And for the things where we're not seeing the tariff feed through, why not? Is it a matter of end market demand and pricing power? Are these various manufacturers eating the cost of the tariffs in some cases, but not in others? How are you interpreting that?
Well, I think we know that businesses are doing a combination of all of these things. In some cases, they're trying to pass along those increases as rapidly as possible. But I would say this, it's probably an easier task for businesses to pass along the cost of tariffs to other businesses rather than down to the consumer level. Because when you're trying to pass price increases to the consumer, well, you know that you're running a little bit of a situation where the consumer may not be able to handle those price increases. And therefore, you're at risk of basically losing market share. I would also say that if you look at even those items that you just showed, they're all goods. And goods are very important. They could comprise almost 1/3 of overall consumer purchases, but 2/3 of purchases are really services. Now, tariffs are primarily and most quickly a goods issue, right? They're good. The the higher tariffs are on goods imports, and that's where we would expect the most rapid pass-through. I think we may not see the more extreme price increases until and unless certain products actually face shortages. Now, the thing is, consumers are very well, we can remember when there was basically shortages of products a few years ago in the immediate aftermath of the pandemic, and that led to very rapid price increases. This time around, I don't think it's going to be as straightforward. Maybe some products will see some shortage and therefore higher prices, but maybe it won't be as broad-based as before. And at the same time, if the labor market is cooling, consumers will have less and less ability to absorb those price increases.
Ryan, what do you think Jay Powell has to say about this inflation report when we hear from him next week?
Well, I mean, I think it's clearly just going to reinforce this kind of wait and see approach, which is to say that, tariffs, the FOMC has clearly stated, represent an upside risk to not only inflation, but also basically to the unemployment rate, right? So it's downside risks to economic growth and upside risks to inflation at the same time, leaving the Fed in a challenging spot. So I do think the Fed is just likely to stay on hold for the time being. We are still looking for some rate cuts later this year, but we expect those to be delivered in a somewhat slow fashion, 25 basis point increments in September, then December of this year, and then finally next March. And that's actually all of the easing that we see through this next 18 months or so. And it's partly because of this balance between higher inflation and these downside risks to growth.
Ryan, I was just going to ask, what do you think will finally give the Fed enough confidence on the tariff side of the equation, on the rising price side of the equation, that it will be comfortable enough to move? Or do you think its hand will be forced by the other part of its dual mandate? Is it just a matter of time that it has to wait long enough to not see the tariffs feed through into prices? How do you think it plays out?
Yeah, I mean, that's a very interesting question. And I feel like we have seen somewhat mixed commentary, even from Fed officials, whether it's the more kind of worrisome scenario where the labor market is really cooling off, maybe businesses are beginning to engage in layoffs, versus the more benign scenario where inflation comes down a bit and growth still looks okay, and so perhaps the Fed can deliver some modest rate cuts. For us, we're very focused on PCE inflation, which of course is the Fed's target, and we think that will stay fairly close to 3%, not just through this year, but also through next year. And if that's the case, that will make it somewhat difficult for the Fed to deliver those rate cuts, basically. And that kind of tends to push towards the more worrisome scenario where the trigger for rate cuts might be a rise in unemployment, an increase in the layoffs that we're getting through. But I do think that both scenarios are on the table. The benign version of rate cuts, I think, will take time to develop because the Fed will want to have confidence that, number one, prices aren't rising, in a kind of uncontrolled fashion. And at the same time, the Fed will be monitoring the activity signals in the economy as well.
And finally, Ryan, we'd love to get your take on the big, beautiful bill, the Trump budget bill. How, as an economist, you're thinking through that legislation, Ryan, how it impacts your models for the economy going forward?
Yeah, well, I think this is also an extremely tricky question. I think we are getting some signals. We want to see whether or not that legislation will pass through the entire Congress before the end of July. That's clearly the ambition. And of course, that's clearly a deadline in a way because Congress will go on recess in August. Now, in terms of the contours of that package, of course, it does mostly include an extension of tax cuts. It does add in, at least in the House legislation, some additional tax cuts, and also involves some spending reductions. So based on what we can see so far, it would tend to basically add some fiscal impulse, if we put it that way, which would tend to boost growth. However, there is a very important counter effect, which is very relevant and clearly present, which is the impact of not only the legislation, but also the fiscal trajectory on interest rates. And we've seen that especially longer term bond yields have faced some upward pressure this year. And so something that, I think you go back and traditionally we would have thought of as stimulative. Now all of a sudden there's a question. Is this package actually stimulative if there's a counter effect, which is higher interest rates?
Ryan, thanks very much for your perspective. Really appreciate it.
Thanks so much.
We're just getting started here on Market Domination. Coming up, Chewy having a rough day following their latest earnings report. We'll check on those shares as well as some of our other top trending tickers on the other side. Plus, General Motors will be committing $4 billion of investments into its U.S. auto plants over the next 2 years. We'll hear from GM's CFO later in the hour to talk about what the deal means for the future of the automaker. Stick around, much more market domination still to come. Let's take a look at some of the trending tickers we're watching. Shares of Oklo skyrocketing today while Chewy and Cleveland-Cliffs are falling. Let's start by looking at Oklo, seeing record-breaking highs today after the announcement of an energy deal with the Air Force, the nuclear power provider being selected to power Eielson Air Force Base in Alaska following a close to 2-year delay by the company. This is pretty provisional here that is being announced on the part of this. Basically, it is the intended awardee of this contract. And as I like to remind folks, whenever we talk about Oklo or any of these small modular reactor companies within nuclear, these things are not happening tomorrow. They're not happening next year. I believe Oklo is targeting developing its first reactor and having it up and running by the end of the decade. So, and probably closer to the end than where we are right now. Exactly.
It was interesting to think about who's buying names like Oklo, because I had Tom Bruni from StockTwits. I was talking to Tom recently, and obviously kind of relatively younger group of folks on that platform. And I did ask Tom, what's interesting to your folks right now in StockTwits? What are they curious about? What are they excited about? What are the themes and trends? And he immediately rattled off. Tom said, it's AI, it's crypto, and the kids like nuclear.
Yeah, well, there's been a huge, just like in crypto, there has been a big regulatory shift with this administration. There's been a big shift on nuclear, although it was already brewing before the Trump administration came in. But now there's a more explicit push in the direction of nuclear. Now you have the players like Oklo, like NuScale, that are developing these smaller reactors. And then you have the bigger players. I mean, Talon Energy extended its deal with Amazon, or expanded its deal with Amazon today. So you have the establishment players like Talon, like a Constellation Energy, that are also working with big database providers. So there are a couple of different facets to it. There's the stuff that is actually working now, or that are nuclear reactors that have been operating, and then there's the new models. And when those new models get up and running, we'll see.
Yeah.
Yeah.
Chewy, let's talk about that name too. That is seeing share prices fall despite beating earnings first quarter estimates. Pet supply company announcing an 8% increase in sales year over year and a 3-cent higher adjusted EPS. Yahoo Finance's executive editor Brian Sozzi did speak to Chewy CEO Sumit Singh about the company's first quarter and his expectations for the next quarter.
The momentum that we've carried out of Q1 actually has continued. In fact, it's just the shape of the curve. So the first quarter, at 6.2% EBITDA margins, for the first time, company crossed the 6% mark. So we're very happy very proud about that. And then broadly, we've guided to a midpoint of, roughly 5.5% EBITDA margins for this year. That would put us at about a 75 basis point expansion from a year-over-year perspective.
So under pressure today, reports noting some of the issues here front and center for investors, gross margin and free cash flow missing expectations. They did reiterate annual sales targets. What do the bulls say on a day like this? Well, Citi, which has a buy on this one, I saw them cited as saying the stock move into the print. They did know, in their opinion, create a kind of a tough setup, perhaps. They argue the multi-year growth and margin expansion story remains compelling. To their point, the stock has enjoyed a strong run. Even now, I mean, you're still up around 20% this year. You're up around 80% over the past 12 months. And most analysts still do see better times ahead.
I was looking at the forward price to earnings ratio of this one. It's 74, which sounds pretty eye-watering, especially when you compare it with something like 32 for Petco. Of course, Petco just came out and disappointed with its numbers recently. So I guess investors are just trying to weigh in this space which thing is more attractive.
Tough setup, says Citi.
Yes. Ending off with Cleveland-Cliffs, which is seeing its shares fall after a deal between the U.S. and Mexico on steel import tariffs looks close, reportedly. The deal would remove a 50% tariff that the Trump administration put on steel up to a specific volume determined by historical trade volumes data. With Trump's steel tariffs announcement being made to promote domestic steel, that walk back could spur more import competition in the steel industry. So we are seeing Cleveland-Cliffs take a hit. We're seeing Nucor take a hit. We're seeing Steel Dynamics and Commercial Metals. All of them are lower. And I guess there are different reactions depending on what kind of steel, whether they make raw steel or flat steel or rolled steel or finished steel products. There's sort of different implications across the sector.
Yeah, Bloomberg is the one who had this report. An agreement they say has not been finalized. I do see analysts cited as kind of weighing in, trying to game out what could be some effects here. Some saying flat steel would be hit hardest and companies that could be affected. Most, they say, Cliffs, Steel Dynamics, Nucor, and Commercial Metals, among others. All right, U.S. stocks lower as investors digested a softer than expected inflation reading and assessed a U.S.-China plan to salvage their trade truce. For more on the latest market moves, let's welcome in here Doug Butler, Rockland Trust SVP and Director of Research. Doug, it is good to see you. So maybe let's start, Doug, with President Trump. Took to social media this morning. Doug, he talked about, hey, listen, we're going U.S. and China. We got a new effort now. We got a new framework, get us back to negotiations. I'm curious what you made of that as a strategist, Doug, and why the lack of kind of reaction in the market? What would explain that, Doug? Do you think maybe that was priced in?
I think a fair bit of it was priced in, but again, the last 4 months have been pretty crazy. So I think, any announcement around tariffs, and it's great that there's a deal on the table. I think we'll all believe it when we see it. And you saw China came out and said, well, it's only 6 months on those rare earth minerals and whatnot. I think a lot of this the year is going to be a bumpy ride as the tariff and trade negotiations cycle through the system.
Do you think now, as investors are watching all this unfolding, is the market sort of moving on from tariff headlines to Fed headlines? Where do you think the attention is?
Yeah, I think we're moving on from tariffs to, the Fed. Hopefully by the end of this week, maybe next week, we'll have the tax and budget plan in place. I think those are going to be the next drivers. Again, as we see, I think those are the short-term impactors over the summer. I do think tariffs could still rear their ugly head over the next couple of months, just as oftentimes there's some mercurialness around either our administration or the response from other countries.
What about that Fed meeting next week, Doug? What do you expect to see and hear?
I think what we're hoping to hear is that rates that they've sort of stabilized their outlook around, maybe it's one cut for the year, maybe it's two. But I think for us, we like focusing on the Fed, but predicting each Fed meeting is not a game we try and play.
All right, let's talk strategy then and some of the names that you're looking at. One of the names that you're looking at that we're focused on after the close of trading is Oracle. That stock's already done quite well over the past year, as Josh pointed out earlier today. So why do you think it's going to continue to have that momentum? Is it just a matter of the AI data center trade continuing and Oracle continuing to be one of the beneficiaries of that?
Yeah, I think Oracle from our standpoint, Oracle is going to be one of the best beneficiaries of that, and they've benefited a lot this past year. We see their growth, their revenue growth, projecting over the next 3 years to be continuing to be really, really strong and growing cloud infrastructure. The other thing is Oracle has such a high recurring revenue base for things that are vital to most companies, so it's hard to cut them out. Now, granted, they're not cheap, and certainly I'm taking a risk here coming and pounding the table on them today of all days. But we think in the long run, Oracle's going to continue to deliver results, especially when compared to some of its other AI peers.
So you like Oracle, Doug. You also like BlackRock. Explain why that one's a buy.
I think BlackRock has done a fantastic job of being incredibly broad. They've got diversification among client base. They are in every geography. They're the largest money manager in the world. They've also done a really good job of building out their product set. So they've got initiatives to really develop into the private markets as we see private markets starting to take command more and more eyeball and market share. Additionally, they have the world-class risk modeling platform, Aladdin, which is invaluable to both institutional and it's now trickling down to the private wealth managers as well. So we think they have the opportunity to grow. Are they going to be subject to, if the market sells off 20%, are they going to fall? Yes, but in the long run, we think BlackRock is going to remain a market leader in the investment management business.
Doug, appreciate your time and those picks. Thank you, sir.
Thank you.
NRG shares powering up, setting new records this year. We dig into the why behind the high of one of the top performers. More market domination. That's on the other side.
NRG is one of the top performers in the S&P 500 this year, propelled in part by what some analysts called a transformational deal to buy some gas-fired power plants. We continue to highlight companies whose stocks are at or near records, outperforming amid the year's volatility, what we're calling the why behind the high. We'd like to welcome in Larry Coben, CEO of NRG, who's here with us in the studio. Thank you so much for being here.
Thank you for having me.
So you guys are, broad strokes, a power company. As I mentioned, you're buying, I believe it's 18 gas-fired power plants from a company called LS Power. So you have power generation assets, you've got sort of a smart home asset as well, and there's some other bibs and bobs there. Talk to me about the portfolio and how it sort of all fits together.
Sure, the portfolio is really one that lets us reach customers from the residential to the largest commercial and industrial companies or some of the new hyperscaler data centers that everybody's been talking about. Our view is that we're here to provide your energy and related solutions, which can, electricity, natural gas, home security, smart home, and we can provide customized solutions to you, whether you own a house in Houston or you're Amazon or Meta or one of the large hyperscalers with a data center, you're a large chemical or semiconductor plant like Samsung is building in Dallas. All of those are possible for us to supply through this strategy.
And so specifically when you're talking about the smart home and how it relates to the rest of it, I guess my question is, why does it make sense to have all of these assets under one roof? What does it do for you guys?
What it does, we already had the largest residential home energy business in Texas through our various brands there, as well as more than 3 million homes in Texas, another 3 million here in the Northeast. And what it does is it enables us to provide more and better services to those customers. So with one app, when I installed a Vivint system, which is the company that we bought, I had 6 apps on my phone. I now have 1. And it controls everything for me in incredible ways. My energy, my heating, it lets me control my air conditioning, car charging, garage door, and a slew of other things. I'm sure I'm leaving things out. So the idea was to have these integrated platforms that would enable us to have enhanced customer services at great and efficient prices.
So let's talk about the LS deal, because as I said, that was one that was viewed as a big deal. Your stock went up something like 25% in one day. So that's part of what's powered it to a record, but it was up even before that this year. So when does that close? And again, how does that sort of fit in? I know it also is going to provide a big boost for your numbers going forward.
Sure. Look, the LS Power deal was really a great combination of the assets that we owned and that LS owned. It enables us to provide customized solutions to more customers for extended periods of time. As people look at uncertainty in the world out there, they're starting to think about, maybe I don't want to buy my electricity on the weekly or the monthly price. I want to lock it in for 5 to 10 years. With power plants and our gas businesses, we have the largest natural gas commercial and industrial business in the country and the second largest commercial industrial electricity business. We can lock in your energy requirements for years. You decide how much risk you want to take. We can give you advice as to what we think the appropriate level of risk is and how to price that, and the final decision can be yours. So this transaction actually doubled our generation fleet, which was very exciting, provided us far more physical assets here in the Northeast, particularly in the PJM region. And
which is the big grid that operates here in the Northeast.
The big grid that operates here in the Northeast, 13 states plus the District of Columbia. And the transaction was also extraordinarily, not only strategic, accretive. We were able to raise our EPS growth rate from a CAGR of 10% up to 14%, and not by assuming anything about price increases in the market, not assuming any data centers, not assuming any synergies or collateral advantages, all of which are part of this deal. So it was an extraordinarily attractive transaction. When you can combine the strategic with the accretive, obviously that's the best of both worlds.
You mentioned data centers, and I want to dig in there a little bit, because one of the things that's causing a lot of excitement in your industry are so-called front-of-the-meter deals between data center operators and power generation companies, where basically you make a deal, you or whoever makes a deal with one of these hyperscalers to sell them power at a price that is not a regulated price. So you negotiate a different deal.
Correct.
What's anything planned on that front?
We're going to have a very fulsome update on our second quarter earnings call, which we've promised all of our investors. And so I'm going to have to wait until then to provide you the inside scoop. I'm happy to come back then and talk to you about it as much as you want. But look, this is a huge market. There have been a couple of very large deals announced in the last couple of days, one, by Talon and Amazon and Constellation and Meta, great deals. And I think what that shows is, it's interesting, when there's not a data center deal announced for a month or two, people think data centers aren't real anymore. I think after this week, people realize, yeah, they're real. Just, these are very complex transactions. We've been actually thinking about doing a webinar to explain how complex they are, but we're super excited about our data center strategy. The assets that we purchased from LS will allow us to have a much broader and more interesting menu for hyperscalers and other data center providers, as well as other large load users. We don't want to lose sight of big industrials and onshoring of manufacturing. So we're super excited about our prospects.
The last thing I want to ask you about has to do with your derivatives trading business, because the Wall Street Journal, I'm sure you've seen, has come out with a couple stories yesterday, sort of asking questions about that business and how the accounting around it works. And I wanted to give you the opportunity to respond to that.
Look, we talked to the reporter. Derivative accounting is complex, and some people just don't understand it. Our investors and our stakeholders and our auditors have all looked at it numerous times. This is right down the middle. It's what every one of our competitors does. None of them are concerned about it in the least. We're not really getting any inbounds at all. They're kind of wondering why somebody is writing these articles, because it doesn't seem to have a complete understanding of what derivative accounting, how it works in our industry.
I guess I should ask, how big of your business, how big a part of your business is the derivatives trading?
It's not really, we don't really do derivatives trading. What we do is we position portfolios for people. If we know that we have to sell you power in 3 years, we'll buy a derivative to make sure we have the power in 3 years. We are doing far less of the speculative derivative trading than anybody in the space. We do take some positions, but others take far more than we do. So I'm kind of confused by the articles, but I'm not concerned about them.
Larry, thank you so much for being here.
Thank you for having me.
Nice to see
Appreciate
you
it.
in person. Appreciate it.
You too. Thank you.
And a reminder that all week we are continuing to shine a spotlight on companies that are at or near record highs. Be sure to tune in tomorrow to hear from the CFO of Waste Management, Davina Rankin, all part of our segment, The Why Behind the High. In the meantime, stick around. Much more market domination still to come.
Shares of GM riding higher today after the automaker announced it will be committing $4 billion of investments into its U.S. auto plants over the next 2 years, aiming to expand the scope of its domestic manufacturing and produce over 2 million vehicles per year. For more on the news and the latest with GM, let's get it out to the Deutsche Bank Global Auto Industry Conference, where Yahoo Finance's senior autos reporter Pras Subramanian caught up with GM's CFO Paul Jacobson.
Yeah, so Pras, first of all, thanks for having us. It's another great day at GM, and we're here at the conference kind of sharing some of the success, the current market backdrop, as well as the announcement that we made last night about $4 billion of investments into the U.S. So as we look at our landscape, as we look at the world around us, whether it's the tariff situation, EV adoption, et cetera, there's a real opportunity to rebalance some of our manufacturing. So it really starts with our full-size trucks in the Orion plant. While we had been setting that up for a big, large-scale EV production, it's clear that EV demand has slowed a bit, so we're able to fill that back at Factory Zero and really convert Orion to a much better utilized plant for full-size SUVs, which will get us some incremental capacity and help take some of the pressure off our team at Arlington, but also full-size trucks, where we'll be able to fill that plant up and have a really secure future with that plant going forward on ICE production. It also saves us a lot on the tariff side of it and still allows us to run our plants in Mexico for exports or continued capacity, et cetera. And then the announcement at Fairfax, where we're going to do once again what we did at Spring Hill, where we'll be able to produce ICE and EVs on the same production line. This, I think, is one of the greatest assets we have because it allows us the flexibility to adopt with the customer. Because while EV adoption has slowed, we still think it's going to be something that's going to catch on and it's going to continue to grow. And this allows us to build a plant that has that ultimate flexibility and can flex with the customer while also bringing the Equinox ICE vehicle, which is a very successful vehicle, and seen some really good economic improvement from the generations into it. So all of these, I think, are meant about rebalancing. I think it's good for our people. I think it's good for our shareholders and ultimately good for our customers as well.
So this is basically, in some cases, an extension of some production, but also relocating some of it from other parts from Mexico, for instance, to the U.S., right?
Yeah, there's some rebalancing, there's some incremental capacity, but it provides us a lot of flexibility across the system as well. So it's not a capacity increase because we want to maintain that same inventory discipline that we've maintained, but it does give us the flexibility to respond to growing demand from our customers because we're really excited about the share gains that we've continued to accrue over the last few years, and we want to be able to bring our great products to our customers.
Yeah, I think it's interesting to see how you can actually build both powertrains on the same plant. I think it's sort of people thought that was not possible, but I guess that is with the way that new manufacturing exists. So
I can assure you it is because I've actually tried it at Spring Hill. I went and did a day in the life and worked on that assembly line where there are ICE and EVs, and I will tell you I have a deep appreciation for our employees that do that every day because it's complicated and it comes at you pretty quick. But our team does a great job, and the fact that we've been able to integrate that complexity is such a great tool for the company to operate efficiently.
And it'll take a couple of years to get going. 3,000 to 4,000 workers hired there for these new initiatives. This is more of a longer term thing, not a short term sort of plan to mitigate some of the tariff efforts, right?
Yeah, so much of our capital spend is long term, and that's good because it often costs a lot of money, and $4 billion of capital is a big pill to swallow. But at the end of the day, it's the right investment at the right time that is going to pay dividends into the future. So we're getting asked at the conference, is this a bet on tariffs? Are you speculating as to what tariffs? This has a little bit to do with tariffs. It has a lot more to do with balancing the organization for what we think the long term is going to be. And I think the team has demonstrated a lot of strength and resiliency, whether it was through COVID, through the chip shortage, et cetera. And this is just another tweak to the macro environment, and we'll work our way through it. You don't hear us complaining about it. We're just responding to what we see out there and making the best decision for our people and for our shareholders.
So in the near term, a lot going on there with pricing and tariffs, and there's also offsets, right? And I think there was some hope that the offsets would help some of the tariff exposure. Is that what you're seeing now, or is there some sort of changes happening now for you guys in the next 2 quarters, sir?
No, we're still working on that. I mean, we shared at the conference today that our peak tariff exposure and impact was going to be in the second quarter because it takes time for us to do some of these initiatives that we've talked about. So there was some go to market. So we've already said that we were kind of comfortable with the pricing and the environment. We didn't necessarily need to change prices to respond to where we were, and I think that's a little bit counter to what we've seen from others. And we're going to continue to price to demand and make sure we're making the best decisions for our customers and for our people as well. There were some footprinting changes and manufacturing changes. So decisions like we made with increasing the line rate at Fort Wayne to produce an extra 50,000 trucks, optimizing where imports and exports are, et cetera. We've done a lot of that, that there's still some work to go, and that's going to take some time to come in. And then the third bucket was just general cost austerity. We learned a lot of valuable lessons about our flexibility and cost management in COVID. I will say this is very different than COVID, because at COVID, people weren't going to dealerships to buy vehicles. Today, they're going to dealerships and they want our vehicles, and we need to be there to be able to produce it. So we got to get at cost efficiencies differently. And that's what we're focused on doing. We got a good head start that we've made in the last 6 weeks since announcing that, but that'll take some time to ripple in. And as that does, we think the net tariff exposure will continue to come down.
I know you guys are trying to target 30% savings from the tariff exposure to try to minimize that exposure for the year. Is that part of that equation that you're holding pricing, right? That as opposed to what your competitors doing?
Well, I think pricing is a piece of it, and you've seen that from the market as a whole. But we don't want to use tariffs as an excuse for pricing. We just want to be able to price our products consistently, and you've done that. Our pricing strategy has been very different than our competitors, but we also think our portfolio is much different than our competitors. We're seeing a lot of strong demand for that, and despite the fact that we haven't done as much discounting as others have, we've grown share. At the time. That's somewhat unprecedented in the history of the industry, but I think is a testament to our products and to our team and our product design team to be able to do that. And the way we've gone to market, our customers have responded to it.
So quick follow, are there any changes to the import strategy from, let's say, Mexico or places like that, Canada?
Well, I mean, obviously the production changes that we've announced today will start to come online in 2026 and 2027, and that will result in some rebalancing of production into the U.S. So we'll produce over 2 million vehicles now in the U.S. for the U.S., and that'll be a great step forward for us. I mean, we still have import vehicles from Korea, and as we've said before, those vehicles still do really well. They don't do as well as they did before the tariffs, but we're optimistic that the governments are going to be able to work out, a trade agreement that ultimately is going to allow us to continue. But we're kind of waiting to see how that works out, and we'll make the right decisions for our customers and for our people.
To keep things as is until you're able to adjust production to it,
and understand what the landscape is gonna be like, and if tariffs remain a big piece of it, there's some levels where we could continue to produce. There's some levels where maybe we need to think about cutting it back, et cetera. But we don't have to rush into those decisions. So we've been pretty calm and pretty methodical about how we've adjusted to this, and the team's been working hard on that really since last November in terms of building this playbook, and that's why I think you see a little bit more of a calm demeanor coming from General Motors than what you've seen from some other players in the industry.
All right, so now more fun questions now. So I know you got a lot going on, a lot on your plate. But what are you looking forward to this year? You mentioned market share gains here and there with certain products, Equinox in particular. What's sort of exciting you about the business, but also from the financial point of view as well?
Well, I mean, what excites me about the business is our product portfolio is just really continuing to perform excellently in the market, and that's something that I think in my role as CFO, I get to share the good news and the achievements of what the team has done, and I'm so excited. I haven't been at GM long, but seeing the pride in the people's faces that are developing these products and having the type of success they are, it's really inspiring to see. And I think what puts us on a strong financial footing is to be able to reinvest in that product portfolio to make sure that we can continue to make it great for the next generation and the next iteration of products going forward. So whether it's ICE vehicles or the electric vehicles, and the adoption rate has slowed down, but we're actually seeing our adoption rate pick up at significantly higher rate than the rest of the industry. And that's because of the product and the quality that GM is offering. And we think that can continue even in a world of slower adoption. So we're winning over customers on all sides, and we want to make sure that we bring them that choice of a great portfolio of GM products. And we're going to do that in 2025. We're going to do that in 2026 and beyond. And it's exciting to see.
So even in the face of potentially losing that EV tax credit, GM's sort of broad portfolio of EVs could continue to thrive here.
Yeah, I think we have tried to, obviously we have been advantaged from the tax credit the way everybody else has, but if you look at our go-to-market approach, we're not offering nearly as much incentives as everybody else is, and I think that's a juxtaposition between where demand is and where the regulatory requirements are. So, we're optimistic that the regulatory requirements will get to something that'll be more akin to what customer adoption is, and that we can be there for customers, whether they want an EV or they want an internal combustion engine vehicle, and be able to provide that wide portfolio. So we're still committed to it. It's going to grow slower than what we thought, and that's the reality, but we have to pivot to that. Our job is to balance that for our shareholders, for our people, and for our customers.
And for you, it's day to day. The news changes. The potential deal in China. Maybe we'll see one in India soon. Korea perhaps on the line. So a lot going on in your world. Paul, thanks so much. And we didn't even talk about Cadillac and racing, but hey, big
weekend coming up.
Yeah.
We're rooting for the Cadillac and the Corvette teams, and hoping for a good showing.
Yeah, it's gonna be a great one. Thanks, Paul. Appreciate it.
Excellent. Thank you so much.